Welcome to the Deep Dive. We're here to cut through the noise, give you the vital insights. Today, we are zeroing in on Tri Homes, specifically their Q2 2025 earnings call.
Yeah, it's a really interesting one. It gives us a window into a major player in housing, navigating what management themselves called a challenging market, but also one full of opportunity.
Exactly. So our mission today for you is to really unpack this call, pull out the essential nuggets, give you a clear picture of Tri Pointe's performance, their strategy, where they're headed.
Right. And maybe keep this thought in the back of your mind as we go. In this kind of choppy market, how does Tri Pointe focus on premium products, that old price over pace thing? How does that set them apart? Or maybe even let them lead as those bigger demographic trends play out?
That's a great frame. Okay, let's jump right in then. The results. What did Tri Pointe actually deliver in Q2? What's the story there?
Well, they actually beat the high end of their own guidance, which is notable. They delivered 326 homes in Q2.
Okay.
And that brought home sales revenue to $880 million. Average sales price was about $664,000.
664. So yeah, definitely confirms that premium positioning.
Absolutely. It really does.
And what about the bottom line? Profitability. Because like you said, challenging environment, maintaining margins is tough.
It is. And they did pretty well, actually. Adjusted home building gross margin was 22.1%.
Uh-huh.
Now, that was right in line with their guidance, but it's important to note that's after excluding an $11 million inventory impairment charge.
Right. I saw that specific project, wasn't it?
Yeah, specific Bay Area project they mentioned has been, let's say, difficult for a while. They did say they look at any project where margins get near 10% for potential impairment.
Okay.
But crucially, they also said that list of potentially impaired projects isn't really growing right now, which is, a good sign.
Definitely reassuring. And net income.
Adjusted net income came in at $69 million. That works out to $1.77 per diluted share.
Got it. And SG&A, often a place you see leverage or lack thereof.
Right. Their SG&A expense as a percentage of home sales revenue was 12.6%.
Yeah.
That actually hit the lower end of their guidance.
Oh, nice.
Yeah, they pointed to some G&A savings and just better leverage.
Yeah.
Because the revenue held up. Good cost control there.
Okay, so financials look solid. What about demand? What are we seeing on the ground with new orders?
Demand side. They booked 1,131 net new home orders in the quarter, which translates to a monthly absorption rate of about 2.5 homes per community on average.
2.5. How did that trend through the quarter?
They said it started okay in April, actually peaked in May, and then sort of trailed off a bit in the back half of June.
Okay.
But, they frame that as pretty consistent with normal seasonal patterns. So steady, managed demand, maybe not explosive growth.
Right. Makes sense. And how does this all sit on their balance sheet? Because financial strength gives you options, right?
Absolutely. And their balance sheet is, it's really strong. They ended the quarter with about $1.4 billion in liquidity.
$1.4 billion.
Yeah, and that includes $623 million just sitting in cash.
Wow.
Their home building debt to capital ratio, a very healthy 21.7%. And get this, net debt to net capital was just 8%.
Only 8%. That's a fortress balance sheet, basically.
It really is. It gives them tremendous flexibility, cushions them against, market bumps, definitely sets them apart.
And with that kind of financial strength, it leads right into capital allocation. Their share buyback program has been pretty significant for a while now. What happened there in Q2?
They kept the foot on the gas. Returned another $100 million to shareholders through buybacks in Q2.
Just in Q2?
Just in Q2. That reduced their share count by 3.5% in the quarter alone.
Mm-hmm.
Year to date, they've repurchased $175 million. That's taken out 5.3% of their shares outstanding this year.
That's aggressive.
It is. And it really speaks volumes about management's view of their own stock's value. They mentioned the stock trading below book value.
Right.
So buying back shares at that level, it's a powerful way to boost per share value. It suggests they think the market's getting it wrong.
That it's maybe the best use of capital right now?
Arguably, yes. They seem to think so. And the long-term impact is huge. Since they started the program back in 2016, their share count is down 46%.
46%. Incredible.
And book value per share is up over 12% just in the last year. So it's a real conviction play.
Okay, that really highlights their confidence. Let's shift now to management strategy, especially around this challenging environment theme they kept hitting. What are the specific challenges they're seeing?
Yeah, they mentioned a few things repeatedly. Continued policy uncertainty, geopolitical tensions. They feel that's weighing on buyer confidence.
Okay.
Plus, they're seeing rising housing inventory levels in some places and definitely a softer pricing environment in several markets.
So macro headwinds impacting buyer sentiment, plus some micro market shifts.
Exactly. It's a mix they're navigating.
And the response seems to be doubling down on this price over pace idea. What does that actually look like in practice?
It really ties back to who their buyer is. They're focusing on balancing, how fast they sell versus getting the right price community by community. They're actually moderating their construction start pace to keep spec inventory in check. When they say demand is fairly inelastic, they mean their specific higher income buyer isn't as spooked by rate hikes or small price bumps as maybe a first-time buyer would be.
So they can afford to be patient on price, even if it means fewer sales.
Precisely. They'd rather protect margins and profitability than chase volume just for the sake of it. It's a bet on the resilience of their customer base.
Makes sense. So how do they use incentives then, if they're focused on price?
The incentives are very targeted, not broad discounts across the board.
Okay.
They're mainly focused on things like design studio options, helping buyers customize, and also mortgage rate buy downs.
Yeah.
Those seem to be the main levers.
Gotcha.
Incentives were about 7.1% of revenues in Q2. They expect that might tick up a bit in the second half of the year, but they say it's already baked into their margin guidance.
So managed incentives, not panic discounting.
Exactly. Very deliberate, protecting that premium feel.
And you mentioned the buyer profile being key. Can you give us a bit more color on who's buying these homes?
Yeah, the numbers are pretty striking. For buyers in their backlog using Triant's mortgage company, the average household income is $220,000.
$220. Okay.
Average FICO score, 753. Loan to value around 79%, and debt to income ratio about 40%.
Wow. That is a very, very strong buyer profile.
Exceptionally strong. And you can see how that underpins the whole price over pace strategy, right? Gives them confidence they can hold the line on pricing because their buyers have the financial means.
Absolutely. It gives them that buffer. Now, related to financial strength, they also tweaked their credit facility.
They did. They extended and actually upsized their main revolving credit facility. It now runs out to 2030.
Okay, long runway.
And they increased the borrowing capacity by $100 million, up to $850 million now.
So more capacity longer term. What's the strategic thinking there?
It's about locking in that long-term liquidity and flexibility. Reduces refinancing risk down the road, ensures they have the capital readily available if, attractive opportunities pop up, without feeling constrained, just reinforcing that financial fortress.
Makes sense. And that strong balance sheet presumably lets them be picky about land.
Exactly right. Their land investment strategy is described as disciplined and selective. They're not just buying up tracts everywhere. They're focusing on opportunities they think will produce the strongest returns, specifically in their core markets. It's about quality over quantity in the land pipeline, too.
And does that pipeline support future growth?
Yes. They believe this land position sets them up for low double-digit growth in their ending community count in 2026. Sure. So they are definitely planning for future expansion, but in a very measured way.
Okay, let's look forward then. Guidance. What are they telling us to expect for Q3 and the full year? Any changes?
Okay, for Q3, they're guiding deliveries between 1,000 and 1,100 homes.
Bit lower than Q2.
Bit lower, yeah. Average sales price expected between $675,000 and $685,000, so ticking up slightly.
Interesting.
Gross margin anticipated in the 20% to 21% range, and SG&A ratio between 13% and 14%.
Okay. And for the full year 2025?
For the full year, they did adjust guidance slightly lower on deliveries, now expecting between 4,800 and 5,200 homes.
Why the trim?
They cited those slower market conditions they saw emerge during the spring selling season. Just being prudent, it seems.
Right.
Full year average sales price projected between $665K and $675K, and full year gross margin between 20.5% and 22%.
Okay. But they still sound confident about hitting the back half, especially Q4.
They do. They express confidence in hitting the implied Q4 volume, which looks like maybe 1,500 to 1,600 deliveries. They believe their existing spec inventory and typical seasonalities support that. So not a panic move, more of a recalibration.
Got it. And what about those new markets they've been talking about? Utah, Florida, the Carolinas. How are those progressing?
Yeah, those expansions seem to be a really key part of the longer-term story. They said they're on track. Okay. And they expect them to contribute meaningfully to both top and bottom line growth over time. They specifically use the phrase notable inflection in performance from these new divisions starting around 2027.
2027. So a few years out, but potentially significant.
Exactly. As volumes ramp up and they get better operating leverage there, it's definitely positioned as a major future growth driver, diversifying beyond their current footprint.
Okay, let's drill down into a few operational details. You mentioned SG&A earlier, hitting the low end of guidance. Can you unpack that a bit more? Why was the ratio guided higher for Q3?
Right. So the higher expected SG&A ratio in Q3 is mainly about leverage. With slightly lower volume guided for Q3, those fixed costs get spread over fewer deliveries, making the percentage look higher.
Makes sense.
But importantly, they stress that the actual fixed G&A, the dollar amount, is down year over year. So they are watching spending closely and being efficient. It's just the math of lower volume impacting the ratio.
Got it. Discipline on costs, but the percentage moves with volume. What about inventory? Spec homes, are they building up too much?
They're actively managing that. They anticipate that overall inventory levels, including spec homes, will actually be down year over year by the end of 2025.
Down year over year, okay.
Yeah, so they're working to normalize those levels, aligning with that price over pace approach, trying not to get caught with too much unsold inventory.
Smart. And build times, any bottlenecks there, or are they keeping things moving?
Actually sounds like they're doing well there. Current average build time is about 115 working days.
Which is roughly?
About 5.5 to 6 months calendar time. They said they're meeting or even slightly ahead of schedule right now.
That's good to hear.
And they're not standing still. They mentioned implementing new initiatives, new templates, trying to improve those cycle times even further. Faster turns are always good.
Definitely. Quicker capital turns, happier customers. Now, one risk factor, especially with move-up buyers, is needing to sell an existing home. How does Triant handle those contingencies?
That's a great question. They do use contingent sales, but quite strategically. Only about 5% of their current backlog has a home-to-sell contingency attached.
Only 5%? That seems low.
It does, and it sounds like they're very disciplined about it. They set limits per community, and they do thorough due diligence on the buyer's existing home and situation before accepting the contingency.
So they're careful not to take on too much risk there.
Exactly. They said this leads to a very strong success rate for those contingencies that they do accept without letting it become a major chunk of their backlog. It's managing risk while still accommodating that buyer need.
Okay, let's zoom out a bit to the broader investor context. The call painted a picture of regional differences, right? Really highlighting that choppy market idea.
Absolutely. The regional breakdown was quite telling. In the West, overall absorption was 2.5. But within that, places like the Inland Empire, San Diego, Seattle were stronger. Sacramento and Arizona, though, were softer.
Okay.
Central region averaged 2.3 absorption. Austin, Dallas, Denver were softer there.
Yeah.
But Houston was holding up pretty steady.
And the East?
The East was actually the strongest region for them in Q2, averaging 3.1 absorption. DC Metro and Raleigh showed robust demand, while Charlotte was kind of tracking with the company average.
So really reinforces that housing is local, doesn't it?
It really does. You can't paint the whole country with one brush. It shows why their community by community approach, balancing pace and price locally, is so important.
And did they touch on the broader affordability issue? How does that fit with their high-end buyer profile?
They did. Management's view is that the inelastic demand they see is less about overall affordability and more about buyer confidence among their specific clientele, those high-income households. They acknowledge that the entry-level market, serving buyers with less financial cushion, is probably facing more pressure, needing more incentives to keep sales moving.
So their segment is somewhat insulated, but they see the pressure elsewhere.
That's the sense you get. Their focus on that affluent move-up buyer gives them a bit of a shield from the broader affordability crunch, at least for now.
So stepping back even further, what's their ultimate take on the long-term housing picture?
Yeah.
Still bullish.
Oh, definitely. They remain very confident in the long-term fundamentals. They point to favorable demographics, that persistent undersupply of housing. The basic building blocks are still there.
Right.
They see the current choppiness as presenting challenges, yes, but also real opportunities. They sound unequivocally positive about the industry's prospects over the next, say, 3 to 5 years.
Yeah.
And they see their own organic expansion into those new markets as a key way to capitalize on that.
Okay, that's a strong conviction message. Which brings us naturally to our favorite segment. This is not financial advice trade idea, remember folks, purely for entertainment, food for thought.
All right, let's have some fun with it. So given everything we've discussed, That fortress balance sheet, the really aggressive share buybacks, especially below book value, and that clear path for growth with the new markets. Here's a thought, perhaps a bit out there. What about a long position in Tri Pointe? Maybe using something like long-dated call options, or perhaps even carefully considered margin.
Okay, where's the conviction coming from on this outrageous but plausible idea?
The thinking is twofold. First, those massive ongoing share buybacks could act as a pretty significant floor under the stock price, especially while it's below book. Management is effectively putting a bid under their own shares.
Right, creating demand.
Exactly. And second, you couple that near-term support with the longer-term potential from that notable inflection they expect from the new market starting around 2027.
So using any near-term market wobbles as a chance to get positioned for that longer-term growth story.
Sort of. Leveraging the buyback support now to position for the growth kicker later. It's basically a bet that management knows what they're doing with the buybacks and that the expansion plan delivers. Again, just an idea.
Duly noted, not financial advice. Okay, let's wrap this up. What does this all mean for you, our listener, taking all this in?
Well, I think the takeaway is Tri Pointe delivered a pretty solid Q2. They navigated that choppy market effectively by really sticking to their guns on the price over pace strategy.
Yeah, and the strong balance sheet, this consistent buybacks, the disciplined growth plan. It paints a picture of a company that feels confident about its long-term path, even with near-term uncertainties.
Absolutely. So for you, the key things to keep watching would be, first, how those macro factors, policy uncertainty, et cetera, continue to impact buyer confidence overall.
Right.
Second, how those new market expansions actually progress toward that 2027 inflection point they talked about.
Here.
Are they hitting milestones?
And third?
And third, just keep tracking that capital allocation, especially the buybacks. How much are they doing, at what price, and what's the impact on those per share numbers? That's where a lot of value is being created right now.
Excellent points to monitor. And as you think about all this, let's circle back to that provocative thought from the beginning. How will Tri Pointe's clear commitment to its premium niche and that disciplined price over pace approach allow it to maybe carve out a different path or even lead as the long-term housing demand story eventually inevitably unfolds? Something to ponder. Thank you for joining us on this deep dive into Tri Pointe Homes.